Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Have the markets changed character? Just a few weeks ago, it was Catch a Wave and you're sitting on top of the world by the Beach Boys, and now it reminds me of The Clash. Should I stay or should I go? This market can't seem to make up its mind. You got these 100-point up days and then 100-point down days, and I'm not talking about the Dow. And, oh, look, Don on his screen's got our Revere Asset Management bull riding the wave with a handful of gains right there. Here's the question. Don, pull up the next one. Can we keep it? Now you have the bulls and bears fighting. First, it was just a bull riding the wave. Now the bears got on the surfboard, and now he's trying to knock the bull off. So what is it going to be? Is the bull market over, and we're going to resume the uptrend? I've actually got two articles. One's worrying about the sky is falling, and the other one said, look, this is just a hiccup, man. Don't worry about it. Stay the course. Who's right? I don't know. Read the articles and see what you think. And we're going to talk about that more. We're going to dive deep in the markets later. But right now, very quickly, if you thought Bidenomics was bad, wait till you hear the next brilliant idea. Taxes on unrealized gains. What are the problems with taxing unrealized gains? Let me count the ways. I mean, isn't that like getting taxed on your salary before you got paid? Me think so. Now, first of all, how do you value a non-public entity? Like if you got a stock that's being traded every day, day in, day out, at the end of the quarter, you will know what the unrealized gain is. But if it's private equity, if it's real estate, and there's not a bid and ask price every day, who's the arbiter of truth? Who's going to value it? It's like, it's almost like the Trump real estate deal, which really might be the point. Okay? They're going to get to decide what they're going to tax you on, and they're trying to do this for the wealthy people. But if you haven't sold, you may not have the taxes to pay the tax. Think about this, folks. Let me put it to you in a very easy example. What about your home? You know, homes have been on a tear for the last 10 years. You haven't sold your home. What if your home rose by 15%? Now you got capital gains, and by the way, they're high because you're rich now, okay? You're going to pay gains on your home even though you haven't sold it yet. So you're going to have to go sell other assets or sell your home to pay the tax, right? So let's think about this. In private equity, IPO, a lot of these companies, all these companies, Amazon, Facebook, Tesla, they all started as a pipe dream in a guy's basement and then they talked some private equity guys, some wealthy guys into giving money, taking lots of risk to be able to fund these before they go public. Well, if you start valuing these private deals by some arbitrary measure and you haven't sold yet, these deals are not going to get done, or you're going to put a damper on them. It's going to cause downward pressure. Now, think about this for leading stocks, the best of the best stocks. Every quarter, you're going to look, oh, these stocks had the biggest gains. Oh, you got to pay tax on that. I haven't sold it yet. Tough. We want the money. You're going to have to sell those leading stocks to pay, or some other things, to pay those gains. It's going to put downward pressure on the best of the best. You're punishing winners and rewarding the losers. You're going to equalize investments. There's your equity right there, folks. There's your equity. Makes all stocks. It is just a terrible idea. You want to talk about misallocation of pricing? You want to talk about distorting economic reality? If you don't have the cash flow, they're actually taxing something without having the cash flow to pay the tax. It's just crazy. Now, here's another brilliant light bulb. They're increasing taxes on these big wealthy corporations, but on the other side of their mouth, they're saying, we're going to give you billions for this. If you build some chip, it's the chip bill. It's called chips, actually, and they're giving billions of dollars to big tech to build manufacturing and do things here in the United States. But then they're going to tax these evil, rich, big corporations on the same side. So they're giving them money, and then they're going to tax them. So really, is that a wash or what? Why don't you just kind of give incentives if you build manufacturing here and not have to worry about it? So who do you think the lobbyists are? Who do you think the politicians are really representing? You think it's you or big tech? They're telling you they're going to tax big tech to make you feel good, but then they're going to give billions of dollars to big tech for these grants and stuff so that they can pay the tax. Folks, it's all a shell game. And oh, by the way, there is no such thing as corporate tax. They simply pass it on to you. Corporate tax is an expense just like payroll, rent, utilities. If they can't pass it off to you, they go broke. They go broke. Jobs, people are out of work. Here's one other thing that I really have a problem with. What they don't tell you is the lower the tax rates, the more revenue the Treasury actually brings in because the economy does better. Now, you can argue about whether you want to spend it on bullets or babies, on social programs or defense. That's a totally different argument. But if you want to bring in more revenue, which is what they say they want to do, why not just lower the taxes? But I digress. That would be too. And by the way, it's not just Democrats. Okay, the Republicans are doing a lot of stupid stuff too. Okay, so nobody in Congress, nobody up in Washington D.C. has a patent. Okay, has a monopoly on stupidity. In fact, I think Washington D.C. is the global epicenter of stupidity. But again, I digress. Let's get into it, and let's talk about the markets and the mailbag, because it's your money, not DC's money. Remember that. They're doing everything they can to take your money. Even if they call it corporate taxes, it's your money. It's your taxes. When they say corporate taxes, they're raising taxes on you, not the corporations. Don't be a useful idiot. Don't buy into that. Okay? If we want to generate and stimulate, let's actually lower taxes, and you'll actually bring in more revenue, and then you can still spend it on the things we want to talk about. All right, I'll get off my bully pulpit. I just couldn't believe that. About Don, what do you think about taxing unrealized gains?
It's never going to pass.
I don't know, Don.
Too many connected rich people have too much to lose. It's a talking point.
Now that's
rhetoric.
A good point.
It's rhetoric.
That is a good point. That's kind of like the lobbyists.
Election rhetoric.
It's kind of like the corporations. Okay, if you want to make us your whipping boy, if you want to make us your platform, tax the rich corporations, then you need to give us some kind of big billions grant money and wrap it up like you're creating jobs in America so that you can pay us for the money you're going to tax us. It's all a shell to game close, folks. All right, I digress. Anyway, there are some articles in the mailbag. Just a correction, or is the bull market over? And then you've got Gary Shilling, sky high stock prices, a cause for worry. And then the fiduciary rule did get passed. They're protecting you from rolling it out. They're making it difficult to roll it out to someone like us because they want you to leave it in your 401k and maybe do an annuity in there instead of rolling it out and doing an annuity on the outside. They want to control the annuities. They don't want you to do an IRA rollover into an annuity. Here's a hint. Don't do the annuity at all, or at least analyze it. Call me first. We can talk about it. All right. Now we're going to the mailbag. On 420, KC, good morning from beautiful Puerto Vallarta, where we are on vacay. Folks, that is a dedicated stock nerd. She is on vacay with her husband in Puerto Vallarta, and she's looking at stock charts. I hope she's at least on the patio on the 10th floor looking out on the beach. But in any event, I wanted to ask you guys your opinion on the MACD. I know no one indicator is a holy grail, but after studying a chart, seems like the MACD can give a warning signal when buying or selling pressure is easing up. Look at NVIDIA on a daily chart. The MACD crossed to bears on 314. It looked like we had a negative divergence between 314 and 326, with the stock continuing to trend up while the MACD was accelerating to the downside. Also, if you look at volume bars during the time, you see red and green bars, but MACD shows there was accelerated selling during that time. All bars on the MACD starting on 314 are red and grow in significance. I have been guilty in overcomplicating my trading and trying to simplify the process. Chart of the NVDA uses the 513 cross, those are the parameters, which is something I adopted from Carolyn Borodin, the Fibonacci Queen. The 5 crossover on 3, the 5 crossed over the 13, on 4-2. The 821 crossed on 4-5. Copying Ted and Connor as I know they would probably like to weigh in as well. Chart below, thank you. Don, this is Don's response. As you said, Casey, there is no one indicator that is the holy grail. MACD can be very useful, but it's not perfect. No indicator is. All indicators are different ways of representing what price is doing, and no indicator is going to say sell NVIDIA and all other AI data center related names, because SMCI didn't raise guidance, which happened on Friday. At the end of the day, all we can do is weigh the evidence and proceed according to the rules. Thanks for reaching out and enjoy your vacation. Don. Here was Ted's answer. Hi, KC. MACD divergences can serve as harbingers of bullish or bearish future price action, but like you said, are secondary. I sometimes look at MACD, but the larger trend price volume but the larger trend, price action, volume, moving averages, and support and resistance are the most important, meaning they're primary indicators. I do, however, use MACD with the 620 setting on the 5-minute chart for precision entries coupled with daily and weekly levels. What Ted is saying there is when he's bird dogging a stock and he knows he wants to get in, he'll use that 620 settings on a 5-minute MACD chart to time his entry into the stock. And with that, Don, do you want to cover that quickly before we go to the next mailbag?
MACD's it's similar in a way to stochastic. Those signals that fired in the same time period on the stochastic and then unfired back up to the upside before breaking down again. There's no perfect indicator. I'm primarily a market smith guy. MACD isn't on here. I use stochastics. Ted uses a couple of more indicators on his charts in deep view, but it's a combination of things. And my comment was about there was just a giant sell-off in all data center names last Friday based on SMCI not raising guidance, which when you think about it is kind of nutty, but we respect price. NVIDIA has reclaimed all of those losses from that day, gotten back above the 21 and the 50-day moving average, and we got back into it today. SMCI hasn't reclaimed those all those losses yet, and is still below the declining 21. So there was a motion in the market last Friday when this came out, and they threw the baby out with the bathwater,
Or sell-off,
so to speak. Yeah.
And by the way, one thing I would like to point out, because, and this, look, I'm guilty of it. Everybody is guilty of it. Every trader. And the old adage is it's easy to read the left side of the chart. It's hard to read the right side of the chart because it hasn't formed yet. You're trying to interpret what the chart is giving you on probabilities to the right side of the chart. So after the breakdown, once you see that, it's oh yeah, now you can see it and you can look into it. But the one thing you've got to be careful of is that you're not data mining after the fact and cherry picking that what actually matched. I'm not saying she's doing that. I'm saying you got to make sure that you're not matching and picking the indicator that actually unfolded correctly that time. Doesn't mean it'll unfold correctly every time, but it unfolded. You said, we could have watched that one. So in practice, what you should actually do in practice is, you keep a journal, and as you're doing things on whatever indicators you're looking at the end of each day, make little notes on where that position is and what that indicator is telling you and your interpretation. Because then later, a week later, if the stock does break down, you can look back and say, what was I thinking in real time during that time? And what was my interpretation? Did I get out or did I not? What was the move? That'll help. That's one way that's kind of one discipline to kind of help you not infer things after the fact. Sometimes they call that Monday morning quarterbacking. It's easier to do, and I'm not saying you do it purposely. I'm saying when you're analyzing in hindsight, you actually will you'll see things that are much, much more obvious now. You're going, oh, well, yeah, I see that now, but you're not seeing it then. All right. So that's that one. All right. Here's another one. I will take this one first. I'm going to do this in reverse order. And this is from JW. Actually, these are both from JW. A new client, actually, in full disclosure. Since I added my portfolio with Revere, I'm following along your buy and sell orders. I noticed you bought Spot, ticker Spotify, ticker SPOT, at 309 spot 59. What is your stop loss currently on that position? Just trying to understand. Thanks. Don, it was sized at 1% to be able to handle a visit to the 50-day simple moving average with a 15 basis point max loss. Great questions. 15 basis points, folks, means 0.15%. So every 1 basis point is 1/100th of a percent. So 0.01 is 1 basis point. 100 basis points is 1%. Okay. So with that, now I wanted to clarify that real quick. My comment, when Donna's talking about a 15 basis point or negative 0.15 max loss, he is talking about the portfolio the drawdown on the portfolio itself, not the stock itself. So the stock could have an 8%, 9%, or heck, even a 15% stop loss if it's super volatile, right? But then you adjust the actual position size so that it doesn't matter whether your stock has an 8%, 6%, or even a 13 or 15% stop loss. If your stop gets hit, because you don't know which stock's going to get hit, which stock actually gets stopped out, any of those would have a negative 0.15%. And this, I'm talking about your starter position on the portfolio. So you're actually standardizing you're customizing each stop loss and position size so that you're standardizing each stock to the portfolio so they have kind of an equal impact, because you're not sure which leading stock is actually going to be the one that turns out to be the leading stock. Just like with hindsight, you can't read the right side of the chart. You think these 6 stocks are poised to break out. Well, probably only 2 or 3 of them are going to. So how do you kind of standardize the other 3 so that one of those 3 doesn't really have a negative impact to the portfolio? All right, Don, I put my Don Terpeter on that for you. You want to put your Dan Terpeter on, and was that a pretty good explanation? Or do you want to clean that up?
Yeah, and you made a really good point about not knowing which one is going to be the winner. So when the market is correcting, we've got our list of things that are holding up technically, and then we've got our broader list of what are the fundamental leaders that either were or can be technical leaders, and can they resurface. And in this case, Spotify had a great reaction to earnings. It gapped up. We took that initial very small position. So in an environment like this, I would rather take 5 1% positions and give them a wide stop than 5% position and hope I threw a dart at the right one. Because one of the rules of progressive exposure is you need to be making progress before you put new money in the market. Well, suppose of those 5 stocks that I took the 1% on, 4 of them went down or 4 of them went up and 1 of them went down. And instead of doing the 5 1%, I did the 1 5%, and I was unlucky enough to pick the one that was going down. Then I'm not going to be adding exposure because based on the progressive exposure rule, I'm not making any money. So I prefer to spread the bets out a little bit more with smaller position sizes and wider stops to let the market determine who is going to be the leader if the market rights itself. And that's kind of what we're looking at right now with the rebound in the market. We're on working toward, this is as of noon on Friday, a possible follow-through day on the NASDAQ or the S&P 500. We need a 1% gain on above average volume relative to Thursday to get that. And right now we've got the price action, the volume action is mixed. Up on the NASDAQ, down on the S&P, but that's how we'd like to dip our toe back in. I'd been talking a lot about the 100-day moving average and using that. We use different levels. The 21 is our short term, the 50 is our medium term, the 200-day is our long term. But once we break that 21 or the 50, we don't just say, okay, all bets are off until we get down to the 200. We gauge things against the 20-week or the 100-day, also against the 30-week or the 150-day. Because if you look here at a weekly chart of the S&P 500, during the rally up in June, very often on pullbacks, you overshoot the 10-week, come down to the 20-week, or sometimes just come down between those two and then go right back to resuming the uptrend. So we keep an eye. We like everything to be above the 50-day, but if it's not, we're just not going to automatically pull the plug, because in this case, we bounced at very nicely and held for 2 weeks in a row that 20-week / 100-day moving average. So that enabled us to keep some money in our long-term index exposure. While we got stopped out, the market took us out of individual stock names, and then we start nibbling again based on our fundamental and technical watch list.
Okay, keep that chart up there, right there, real quick. Okay, so folks, if you're watching if you're watching, not just listening, the black line at the bottom is the 200-day. The pink above that is the 100-day, correct? Then
right.
The red is the 50-day, and then the green is the 21 exponential. So the three are simple moving averages, and the green is the exponential, meaning it puts more emphasis on the closer in days. But notice how the 21 crossed under the 50-day, which means short-term momentum, very short-term momentum, was weaker than mid-term momentum, depending on how you define the 50-day. And now the 21 is actually starting to flat hook up again. That would be a very bullish sign for the market. That means short-term momentum is overtaking long-term momentum, and the probabilities would lean toward a bounce or at least a rally in the short term. So, all right, Don, that was a great explanation. Now, do you want to dive right into the markets first? And then, because this last mailbag is actually kind of geared toward Ted. So Ted's segment is actually going to be on that. So I can read that after you want to do the market overview. You want Ted to go first, your choice.
I kind of just gave a little overview with
okay, that's fine.
This explanation here, so that's good. Let's go ahead and move on to Ted.
Okay, so folks, this is the last mailbag, also from JW. Good afternoon. Would it be possible for Ted to do a quick tutorial on how he uses it for I'm sorry, he's talking about the anchored VWAP. The anchored VWAP that was in a previous. Would it be possible to show Ted to do a quick tutorial on how he uses the anchored VWAP for consideration for potential stock selection on one of your future podcasts? I remember Ted mentioning it a few weeks back. it was covered in a prior podcast, if it was covered in a prior, God, I'm having trouble today. If it was covered in a prior podcast, try saying that 4 times fast. PPP. Anyway, how could I view it? Thanks. Don, sure, we could cover it Friday. Thanks for the suggestion. Ted, sure, I'd be happy to cover how I use VWAPs, albeit it is a secondary indicator to price and volume and moving averages. Thanks, Ted. And JW, terrific. Enjoy your weekend. All right, so with that, Ted, bring it home.
Of course, I can cover anchored VWAPs. And previously, I mean, we've done a lot of podcasts. Connor's had some really great segments on anchored VWAPs as well. Maybe we can dig that out and clip it and put it on the YouTube, Dan, if that's a possibility. So I guess before we get into anchored VWAPs, you asked how we use or how I use anchored VWAPs to select stocks. I want to say I don't use anchored VWAPs or VWAPs to select stocks. The core part of my stock selection is first, what is the market doing? Then what are the strongest themes and sectors and industry groups in the market? And then I want to be in the leaders based off the highest relative strength, momentum, and for me, ADR as well, because I want to be the fastest stocks. The anchored VWAP, just like moving averages, helps me manage risk. And almost all the technical indicators we use are just risk management tools, not necessarily to help us predict anything in the future, which they don't in the first place. So let's just break down anchored VWAP. Traditional VWAP stands for volume weighted average price, and it measures the average price of security during a specific period, normalized by the trading volume. And Brian Shannon, he's a CMT and he's a really popular technician. He developed or invented the anchored VWAP, which gives you the flexibility to kind of set the VWAP at any point you want on any time frame you desire. So, I mean, we all like our flexibility to have more creativity in our analysis, and this tool he developed was amazing. Another point I wanted to talk about was you don't just want to anchor the VWAP on any random day or point to fit your narrative. That just leads to more confirmation bias, and that's something we want to avoid. And so 2 main ways I use it. Don has a chart of the NASDAQ 100 or the QQQ ETF. And the first way I use it is measure highs and lows and swing highs and lows. So right here, the longest one you see is anchored at the start of it's anchored at the bottom of the previous correction we had and the start of this current rally we're in. That middle anchor VWAP you see is anchored at year to date. And then the top one, the shortest one, is anchored at all-time highs. We kind of just use this like moving averages, just another tool to gauge various levels and places to risk off, maybe potential support and resistance levels. And you can see that in this recent pullback, we respected that anchored VWAP from the very lows quite well so far. And today we're bumping into that year-to-date anchor VWAP, which is a key level we want to see as well, kind of just signaling to us, on average, are market participants positive on the year or negative on the year. And from the highs, you can see after we topped on that failed breakout, we kept getting rejected at the all-time high anchor VWAP, and that just keeps telling us that this is another key level to watch out for to see if we can retake that all-time high anchor VWAP, to see if we have more upside in this market. And the second way I use anchor VWAPs, Don, if you can pull up the CPNG chart. One of our main setups, or setups that we found that's extremely powerful, are earnings gappers. And the CPNG in the face of the market pullback had amazing earnings and had an amazing earnings report, and it's just been floating higher, which shows extreme relative strength. As you see that the market's pulled back about 5-6% in the last couple of weeks. And what I found in my own studies is that I like to anchor the VWAP to the gap day, and I found all my best trades on earnings gappers. I've seen that the stock never has a day's close below the anchored VWAP on days 3 through 5. And to me, that is a signal that this earnings gap is strong, and there's a higher probability that it's likely to work out. And for the ones that I've taken where I get like a day one close or even 2, 3, 4, 5 below the anchor VWAP, it kind of tells me I have to be a little more tight on this stock, as there's a higher failure rate. But there's definitely other ways depending on your style. You can anchor them to the month. You can go intraday, anchor them to the day. But that's just a regular VWAP anyway, so you can just throw that on. So those are just two main ways I use it. I mean, Connor might even have a couple points because I know he really likes the anchor VWAP as well, if he wants to quickly touch up on that.
Yeah, no, Ted covered it pretty much. Like you said, I think the most important thing when using these is anchoring the VWAP from an important date, because if you just do it from a random candle or a day, that doesn't really give you much evidence in terms of how to use that as a level. So I found from using it that key highs, key lows, year to date levels is the best place to use it, and it can be super helpful there. And that's how we'd have to find the show. It was a couple months ago, but we had huge confluence of the 200-day, the COVID low, and the October low VWAP one couple months back and that marked the short-term low on the pullback. So when they all stack up like that, it can be very powerful. And then
I like this a lot. I like this a lot with the gap ups, and showing who's in charge. If you break back below that level, pulling back to the level and bouncing on it is a great add level or initiation level. And if you break it, it's a very easy stop out along with the low of the gap up day.
So once you get the VWAP or the anchored VWAP anchored at the reason they call it an anchored VWAP is because it's anchored to a specific, start of the year, high or low, whatever. But they really essentially act, once you get the line drawn from where you want, it really acts very similar to support and resistance, right? I mean, that's how you're looking at it.
Yeah.
Yes.
Yeah. Okay. All right. Well, JW, I hope that was good. If you have any other questions, we can certainly revisit that. All right, Don, what do you got next?
Connor's going to comment on sentiment and then on a group that showed extreme relative strength yesterday and is following up on it today.
Yeah. So, Don, if you pull up that picture, sentiment's something we've been tracking a lot, and it can give good insights into if the market's overshooting to the downside or the upside on the pullback. But something that we haven't seen in a while was bearish sentiment get above bullish sentiment. So bears came in at 33.9%, up from 34% last week, and bulls came in at 32% this week versus 38% last week. So huge drop off in the bullish sentiment, and bearish sentiment is coming back. So that's good to see, looking at it from a contrarian angle, and this coincides with the NAM exposure numbers coming down significantly as well. So something to watch. And like Don mentioned in the video last night, Ted and I are going to be starting the weekend walkthrough, so we'll cover these more in depth on that video on Sunday. And so my segment today, I wanted to talk about an industry group that's, like Don mentioned, that's been showing relative strength and falling through to the upside today. So Don, if you want to pull up G5812, that's the MarketSmith industry group. Yeah, so I wanted to talk about retail restaurants. And as you can see from that chart, it's breaking out. It held the 50-day and it's breaking out into new highs while the market's still technically correcting. And before I dive into this, I wanted to talk about some stats that I think are pretty important. So majority of leading stocks generally rise from leading industries. And the IBD research shows that 37% of a leading stock's price movement is directly tied to the performance of the stock's industry group. And then another 12% owes to the strength of the overall sector. So this means that nearly 50% of a leading stock's price performance is linked to its industry and its sector. And just from my own post-trade analysis and review, I've noticed that my best trades have always came when I found a glaring theme with multiple stocks in an industry group showing relative strength. So looking at that retail restaurants chart, you can see it's showing a lot of strength and it's breaking out. And if we dive into the individual names, Don, if you pull up a chart of CMG, everyone knows Chipotle, and I mean, it just continues to trade higher. It gapped up on earnings again, and it's having a day two higher high, falling through to the upside. And I believe they have a split coming up as well. And any stock that's breaking out into new highs on volume right now is showing relative strength and can be a clear leader. Next name, if you look at Texas Roadhouse.
Yeah, baby.
That's right. And this is another one, similar look to Chipotle. It's got a nice flat base. It's held that earnings gap up on the 16th, held the 50-day moving average. Relative strength line is breaking out. That's really good signs. The stock showing a lot of strength. Next one, if you go to Wingstop, this is another one. It's chopped around in the space a little bit, which is expected given the overall market environment right now. But this RS line is 97, and it's got a multi-week flat base, and it's setting up for a breakout with good numbers. And this name, it had an earnings gap above the 200-day a couple months back, and ever since it's been nonstop. And that just shows, like we mentioned, some of our setups, we like those earnings gaps, and it's been nonstop ever since. And then Sweet Greens, SG. This one's a little bit thinner, but it's one of the powerhouses in the group. It's moved over 100% from that earnings gap where it gapped up. It was only trading at $12, and then it gapped up all the way to 17, and it's been moving higher ever since. Now this one's too illiquid for us at Revere, but this name can morph into a bigger name, and if it gets more liquid, it's something we'd keep an eye on. But like I mentioned earlier, it's about looking at the overall group, and just because we're not going to buy it doesn't mean we're not going to look at it, and just gives more confluence for the overall group. And then the last one, save the best for last. This is Kava. New merchandise. It's a recent IPO, and it broke out of this IPO-based cup and handle look yesterday. And one thing I noticed is it held the 50-day, but if you see that RS line, the RS line made a higher low, and now it's breaking out on volume. That was a clear sign of relative strength that it showed, and the pullback was fairly orderly. And this name's got good numbers, and it's my favorite just due to the fact of the price action, the story, the earnings. I've had it many times. I think it's a lot better than Chipotle. And Don, if you pull up a weekly chart of it, you can see that it pulled back to that left side high, and this week's candle is looking like a bullish engulfing hammer. And yeah, if you just that left side high, yeah, exactly. So it held that previous IPO high, falling through to the upside again today on volume with a favorable group, gives us some conviction in this stock, in this area of the market. So to conclude, I just think the main theme and emphasis I want to put on is looking at the overall group of the stocks you're looking at, because the stats speak for themselves. Just one lone soldier with no supporting stocks, it's more unlikely for that stock to go on and make a big move. So the sweet spot is when you see multiple names in a group setting up, and then you find your leader, the one that gives you the best entry, the ones with the best numbers, the relative strength, and that's what you focus on once you find a strong group.
All right, Connor,
So yeah,
man,
that's
that was good. Listen, Kava has the N. That's the N in CanSlim that Bill O'Neill talks about. And you were talking about Chipotle. You like Kava more than Chipotle. Kind of, my daughter came in from Baylor last night, and we were kind of running late, so we went and we just got some food. And so I ate at the Leonard Skinner's version of Chipotle. Anybody catch that? Anybody? Freebirds, and which is actually started in College Station. But I got to admit, my daughter loves Freebirds, but I'll tell you what, I like Chipotle. I just think their quality control, their consistency. But I've got to go try Kava. I have not done Kava yet, and everybody I talk to under 40 raves over it. So, and they're more foodies than I am. So I'm definitely going to have to go check that out. Here's what I wanted to point out though, because here's the overall, instead of using your intuition or what you believe to be true, because we've got all kinds of biases and prejudices in our head unknowingly. Some of them are even, underneath the surface. We don't even recognize, but you wouldn't think that restaurants would be strong right now because of the inflation headwinds. They've got to pass on these higher prices to consumers. And so you think that these restaurants would be struggling and that they would be getting clobbered. And that's not the case. That's why it's really important to do these screens and constantly update, not just for individual stocks, but for sectors. In that IBD methodology, they always talk about the 197 subgroups. You want to stay in the top 50 because that's where the institutional money is being held. But folks, it's even more better than that. Bill wanted to, keep it simple in his book so he could read it, but there's probably a little better way. You want to know the direction of where they're jockeying back and forth. So I'd rather have stocks in a subgroup that's at 70, but was at 130 3 weeks ago and then was 90 and now is at 70 and is moving toward the top 50, than something that's at 30, but a few weeks ago was at 5 and then at 15 and now it's 30 and big money is actually going out of it. So it's not just the subgroup itself where it is in that list, whether it's top 50 or not, it's the direction. It's kind of the moving average over the weeks. Where are they jockeying back and forth? That's a really good way to find out early which next subgroup is going to be setting up. All right, Don, do you have any last comments or things coming into next week? What are you going to be looking for?
I want to point out some subtleties in this retail restaurant chart.
Please.
So we know that the market had a follow-through day and started a rally last November, and the retail restaurant group was correcting along with the market, no surprise there, and it formed a cup and handle. Now, notice while it was putting the handle in, this jagged blue line there is the relative strength line. That was pulling back while the stock was pulling back, while the group was pulling back and putting this handle in. And relative strength was lagging. The market was kind of going sideways while this was pulling back. And then it broke out very strongly. You can see relative strength going up along with everything in the entire group. And then we topped here and started to pull back. This coincided with the entire pullback in the retail group. But notice this time, while it was pulling back, the relative strength line continued to go higher.
Yep.
This is a very big clue on a relative basis how this was performing, that if the market righted itself, the odds were certainly better than average at a minimum that this group would reassert itself. And that's what we saw. You got this declining tops trend line. We talked about all the breakouts yesterday, but this actually started breaking back above the 21-day moving average 2 days prior to yesterday. So it was showing some relative strength subtly while the rest of the market was continuing to pull back. As you can see here, we got the S&P 500 line at the top. I can't use any chart that doesn't have this relative strength line and the S&P 500 line on it. You really need all three of these in order to pick out what's trailing and what's leading. You need the price action of whatever you're talking about. You need a reference point for the S&P 500, and then you need a relative strength line to reference the strength or weakness of what you're looking at against that S&P 500. So this is one of the reasons why this restaurant group stayed very high on our list, and the guys pounced on Kava yesterday when this broke out. So good stuff.
And by the way, I want to make sure Don just gave you listeners a huge gold nugget. And I want to make sure it didn't kind of go. So what he's saying is you want to compare whatever sector or even stock you're doing relative to the S&P. Why is that? Because if you're not outperforming, if your expectation is that it's not going to outperform the S&P, why take the risk? In other words, why, if you can just buy an S&P ETF, which has some diversification, so single stock or even a sector that might be narrow has more risk than the broader S&P with the rotation underneath the hood. If you don't think you're going to outperform on that sector or that individual stock, there is no point in taking that. Just take a position in the S&P, and then if the S&P is weak, then the default is just to cash. I'll go you one better. When Don's picking individual stocks, he wants to believe his expectation is that that stock, once he buys it, will double what the S&P is doing. Because if it doesn't, he could simply take a double leveraged S&P ETF with the same position size as that stock and have a better outcome because he has less risk because he's got more diversity. It's not single stock risk. That's counterintuitive. So you've got to measure everything. You got to measure everything that you're doing against a yardstick. And if that yardstick is better, why do the other? Why not stay with the yardstick? Then if the yardstick is also doing poorly, then you've always got a default to cash or maybe treasuries or something. So anyway, with that, one last thing, I do want the listeners, I want to know what you think of our new shirts. I got these new shirts for the whole team. Ted's wearing a white one. I'm wearing black today. I had my white one on last week. Don's got his black one, and I think Connor has blue. So I want to know,
Navy blue.
I should have gotten red, white, and blue. I should have gotten that. But anyway, and we've even thought about green. And I didn't know if you could notice, but there's a little dollar sign inside the lantern, right? Kind of like Don showed you, the bull, the Revere bull with the handful of cash riding the wave, right? We got these gains this year. We got this nice wave that we've been riding. There it is. He's showing it up there. Now show him the next one, Don. So the market was like that all the way up to about a week or two ago. And now the bulls and bears are fighting, and we're trying to see who's going to win. Because we've got some hard-fought gains, and we don't want to give them up. But if you're just a buy and hold shop and do some kind of rebalancing on some arbitrary date, you better get used to giving up those gains or even having a huge decline every 3 or 4 years. That's why we don't do buy and hold. We're an active portfolio manager. And if you want to learn more about Revere, just go to our website, revereasset.com. Up in the right-hand corner, there's a subscribe button, and you can put in your name and email address, and this podcast will go into your inbox, usually every Saturday morning because we record it Friday late morning. And if you actually go to our YouTube channel and just search for Revere Asset, just Revere Asset, and subscribe to our YouTube channel, you'll actually get it about 1 o'clock, 2 o'clock before the market closes on Friday afternoon, as soon as Zach, our publisher, publishes it. You'll also get Don's daily market insight videos Monday through Friday. Every night the market is open. So we're the most transparent advisor that I'm aware of. We tell you what the market's indices are, the NASDAQ small cap, et cetera, S&P, both short-term, long-term, and mid-term, strong or weak. And then we actually go over items and things we're actually doing in the portfolio. I'll tell you, if you become a client, Don's newsletter really comes alive, because rather than being a little bit out there, kind of esoteric, where you kind of philosophically get it, you're actually going to feel it in real time. Folks, also, lastly, there's a contact us button right next to that button. You can shoot me an email. It'll send me an email. You can put in a stock you want talked about on the show, or a strategy, or if you simply just want a portfolio review. And you can always email any of us, Dan@revereasset.com, Don@revereasset.com, Ted or Connor at revereasset.com. And you can always call us old school at 855 Real Wealth. Folks, remember, it's your money, not their money. It's your money. Be smart with it. We'll talk to you next week on Your Money.
Because it's not about how much you make in the markets, it's about how much of that you can keep.